Turbo Trading with head trader Robert Knight, MBA.
Welcome to Turbo Trading, Psychology of Day Trading. I want to go over a lot of different concepts geared for those that are starting out in trading or new traders, but relevant for everybody. And I have this in here. I like this diagram that I have here with the grenade about to blow up a lot of different stuff. And this is so apropos for what day trading is about. So the psychology of day trading, it's very, very important. We have to make split-second decisions all the time, and we're always looking at charts and data feed, news feeds, Twitters, all these kind of things that are bombarding us all day long, and we need to have split-second decisions in a lot of the things that we're doing. So it's very, very important that we have a clear mind and it's not clouded by any kind of emotions. The emotions are what kill us in in trading, both day trading and swing trading, but emotions are our big bogey. So hence the need for, to be very, very disciplined in trading. And it's a discipline to stick to your trading plan, your stop losses and your profit-taking scaling stocks out, and not being paralyzed by our emotions. And you'll find if you're with us in turbo trading all the time, but if you're new to what we're doing, you'll find that I'm very cold and calculated in our trading room, in our live webinars that we do all day long, from 5 in the morning Pacific time until 1 p.m. 1:30 when the markets close. I never get excited. I don't jump up and down. I'm not yelling. I'm not screaming. It's very unemotional trading, and so some people like it, some people don't. But it's always very calm and cool and collective in the turbo trading room. And the reason is there's just no room for emotion in what we're doing. There's big wins, there's big losses. Each trade is a trade on its own. And we don't get high or low on anything that we do. It's strictly, except when I have hits off my big bong, but we don't get higher or, there's no big highs, no big lows. And, but it's just steady trading. And each trade in itself is a separate trade. There is no, we don't look back. We don't revenge trade. We don't do any trades that reflect on what our last trade were. So what are the emotions when we, for day trading and swing trades? This is not new, this fear, hope, and greed chart. This one happens to be produced by Raymond James Research, and it can be, this can be the trade, intraday, a day trade, or this can be the overall market where we're at. And, it starts here at optimism, excitement, thrill, euphoria. This is where there's the most risk in euphoria, anxiety, denial, fear, depression. Here's your best opportunity when we see capitulation and despondency and depression. This can be a day trade. This can be this can also be like a swing trade or the complete market cycle that we could be in. So where are we right now in the market cycle, in the general market? I would say really we're in a period of optimism, even though the markets are at all-time highs. This is not euphoric. We're not at anywhere near. This is not the most risk, even though markets are trading at all-time highs. It's we've already gone through some of this just recently. Capitulation in end of January and end of February, where we got these huge sell-offs, 70% sell-off in a lot of the stocks that we watched and trade, and when they bottomed out, there was a big opportunity to trade. We got some hope. We're getting a little bit of relief. Now we're back into optimism. But in a day trade, this usually is your right when you have FOMO and you're chasing the stock, and it's starting to spike, and you think you're going to miss it, and you get the euphoria, and this is your maximum risk. And sure enough, you get the stock comes against you. You have an anxiety denial that it's a pullback, fear that it is, and bam, sure enough, when it bottoms out. So, you want to buy the dip, sell the rip. And these capitulations, that's where most of the retail traders and the novices are getting out of the market. This is where the smart money is getting into the market. And so this cycle of fear, hope, and greed, this is where emotions, where you can't let your emotions get in the way. You can't get into this euphoria and risk. And quite often what happens, is you get a big trade and you make a bunch of money, and it's really exciting, and this is thrilling. And so then you start looking at instead of AAA setups, you're looking at B and C plus setups, and you're thinking, because don't worry about it, I got a big cushion, I can make, I can do a trade that has more risk, less perfect setup, because I have a cushion. Absolutely wrong thing to think about, way to go. So what we do find is that there are three main types of traders in the markets, and the biggest one, of course, is the masses that follow like sheep to the slaughter. They don't do their own research. They're not sure how to trade. They follow, somebody, a guru in the marketplace. Quite often ones that front run their members. There's a couple of big chat rooms we know that they do that. Guys with 5,000-6,000 followers. He buys the stock. He tells everybody, this is the one I'm in. Everybody jumps into it, and he sells into that pop. It's one person I know. He made $5 million last year, and he points that out that he made $5 million, but he only does it because he has such a huge following, and he needs a big turnover. He advertised $60,000 a month just in Google Ads, because he needs that big following to push the markets up on the stocks that he's trading. Then there's the pros. Those are the ones that trade. These are your market makers, your investment, the hedge funds. These are the guys that are trading usually to the opposite of the masses. And that's what we try to do here in the Turbo Trading Room as well. We're not chasing the stocks. We're looking for pullbacks, entry opportunities where we can, so that we're not trading with the masses, but instead we're selling to the masses. And of course, that's one of the things that we never do here in Turbo Trading is the moderators here. We never front run our members. And then there's the third kind. This is the algorithms. The algos, what we call in the vernacular. They trade for pennies, sometimes 1 or 2 cents. Keywords that come over the tape, and that's quite often where you see these all of a sudden big swings in the markets, and that's the algorithms that are trading. So the thing about the novice trader or the masses, they falsely create expectations. They believe that trading is easy money, especially when they're doing paper trading. If they're just starting out their paper trading, it seems like they can never go wrong, and that's because they don't have any skin in the game. But we've seen, and just of late, there's been a reinforcement about trading being easy money with the meme stocks, the Wall Street bets. Stocks running for no reason other than the Wall Street bets puts out it's a short, usually a big short position. The big example of that was the GameStop GME that went from $3 to $500. And so, but these guys ride these stocks for hundreds of dollars. But don't take profit when it gets to the top. It's absolutely ludicrous. This is emotions getting involved in the trading, and this easy money is quite often reinforced by a one-time win early in the trading career, which GMA we know was exactly that. And they feel that one good trade means that's the key to success and wealth. But this is a business, day trading. It's a business, and so it's not gambling. It's not one good trade that is your key to success and wealth. It is a pattern. It's a logical steps that you take every time you make a trade. It's not gambling. And so what happens is, as soon as you start, and quite often what's happened is, as soon as they start risking real money in real time, that changes the dynamics of the whole trade for them. And this is where emotions can get in and rule the trade. Just remember, emotions are a trader's worst enemy. It leads to misjudgment and to big losses. So, again, as I say, we're in the turbo trading room. We're always unemotional. We let our big wins, we let our winning trades run. If it goes against us, we're quick to take a small profit or a small loss. But if you can let your big ones run, that'll more than compensate anything that you do if you take a small loss. So what is fear? Well, it's a simple natural reaction to a perceived threat. For traders, generally that means it's a trade going against you. You put an entry in, what your risk level is, what your goals are, but if the trade starts going against you, then you have two reactions. This fear generates two overreactions: fight or flight. If you pick fight, traders ignore their trading plan and they stay in a trade. And typically what happens is they take a big loss because they add to their position, or they feel maybe that their stop was too tight, and so they got the next stop, and then they see another resistance or support level, so they'll wait for that and it goes through that. Wow, there's another bigger one down below here, we'll hold that. And sure enough, it just keeps going down and down and down. And you take a big loss by fighting it. The other reaction is flight. And this is, again, where traders ignore their trading plan. But they exit the trade too quickly. Maybe the stop is too tight. And so thereby they're missing these profitable upswings. So or what happens is, quite often, especially if a trader has just had a string of losses, as soon as the trade goes green, they're up 5 cents or 10 cents, they'll ignore their trading plan and they'll sell the stock. And they're happy that they're green a little bit, but you'll never make money. You'll lose money. Your account will die by the 1,000 paper cuts, because you don't let the trades run. You need to take the emotion out of a trade and let them run. And this is a big thing that we do in the turbo trading room, is we get in these channel trades and we let these stocks run, and we scale out as we go all the way along. But we let stocks run as long as they can, as long as they stay in the channel and they don't, we keep moving our stops up. But rather than selling out in 15 cents, 10 cents, 15 cents, 25 cents, we let the stocks run $1, $2, $3, $4, $5. Now we won't have everything at the when it runs that far, but we'll still have a little bit left as we piece it out as it goes along. And that's one of the things we do here is also give guidance on how to do that. So fear does a couple of things, though. It can prevent a trader from even entering a trade. He or she doesn't trade with conviction. If you have a pattern and you believe in that pattern, then you must enter the trade. And if you take the trade and it goes against you, you have to get out of it, because only 70% of the pattern we find is successful. 30% it's going to go against you. But fear prevents a trader from entering a trade, especially if they've had a few losses. They're afraid to pull the trigger. And then, as I've been talking, fear can have a trader exit the position too early. As soon as you're green, you're happy to get out of it, but you're not catching the big trades. And then, of course, fear also makes you deviate from your trade plan, either by staying in the trade too long or taking profits far too quickly. Now, here's one of the big thing. Greed is your worst enemy. And this is so true. Bulls make money, bears make money, pigs, they get slaughtered. So greed is, along with fear, greed is one of your big worst enemies as well. It is hanging on to a position too long. Now, trying to get every tick. So this is somewhat maybe counterintuitive to what I just talked about, where we let stocks run. But as we have stocks running up, we're selling out. So it's not that we're hanging on to a position too long because we're piecing it out. And so eventually the stock's going to come back and we'll get stopped out of the balance. But quite often we do hit the top tick because we're piecing it out all the way. What this means, greed, is that the trader tries to hold the whole position all the way, trying to get every tick, trying to get the top of the trade. And quite often what happens is he gets whipsawed. Stock goes up and then all of a sudden absolutely gets crushed and it goes back down. And what happens is you blow out of a profitable position at a loss because you got whipsawed and you weren't piecing out all the way up. So you need to piece out all the way, go and not get greedy. You can take singles and doubles and just keep a little bit for that big home run. But, hope and greed go together. You hope that this thing keeps going and the greed doesn't allow you to sell it. And it does keep because your hope is right and your greed is setting in. And then all of a sudden you get whipsawed and the stock comes back in an instant, as we know it does sometimes, and your profit turns into a loss because the trader hopes that he's going to get it back. Another big emotion that we have that we need to, and I talked about this a bit earlier, is paralysis by analysis. It's an interesting phenomenon, and it's overanalyzing your trades. At TurboTrading, I use three main indicators that I use, and then two sub ones that I use for because they're lagging indicators, just to sort of confirm the direction that it's going. We use support, resistance, and trend lines. Those are the only three that we trade with. We don't have 20 other patterns that we're relying on, because if you have too many patterns at one time, you'll never get into a trade because no pattern is going to all of a sudden say, or all those patterns, very, very seldom will all of them align, and you'll never get into a trade because you have paralysis by analysis. So the trader never pulls the trigger because he has too many conflicting indicators. So I use support, resistance, and trend lines, and then the other two that I use are simple moving, or the moving averages, exponential moving averages, 15 or 20 day or 20 period, and the 50 period. And so that just really reinforces direction. They are lagging indicators, so it's not one that I use to put a trade on. Here, this is key. When I was a broker back in the 80s, the compliance officer had a big picture in it wasn't a big picture, but it was like about the size of a university degree or certificate, or those ones you see in the doctor's office on the walls all the time. But his had two simple words: think ruthless. We know the trend is your friend, and that's what we trade at Turbo Trading Room is the trend, and we use trend lines. But that's the only thing that's your friend. The market is not your friend. Nobody, especially the market, cares about your opinion. The market has no opinion. And you can be assured everybody wants what you have, and that's your money. So you need to think ruthless. There's no friends in trading. I mean, we have friends in Turbo Trading for sure. We talk and chat and we can develop relationships and all that. But when it comes down to trading, nobody is your friend. Everybody wants to have what you have, and that's your money. And the sooner you accept that, the better off you will be. And this is one of the phenomenons of this Wall Street bets, these memes. Everybody thinks that all their meme friends, their Wall Street bet friends, are Wall Street bet people are their friends, and everybody's just going to buy stock and they're going to keep going. Absolutely, what the market wants to see. These hedge funds and such, they're just hedge funds and such, and big traders, market makers. They're absolutely licking their chops because of this thinking that these Wall Street bets traders have. The retail traders going in and thinking everybody has the same agenda, and that's just to keep buying stock until it goes to the moon. The hedge funds, they just laugh. They're just so excited when a Wall Street bet new buy comes out, because they jump on it and run it, and the Wall Street bets thinks it's them that is moving the stock up, which of course it isn't, because they don't have enough firepower to do it. It's the big hedge funds and market makers that really give it the oomph. But then the Wall Street bet, all those people who think that everybody's all on the same page, they keep buying and buying and buying, and eventually they manage to take the paper off the professional traders, and then they buy their short position, and then kaboom, off it comes. And all these bag holders are left up here. So key to remember, think ruthless. Nobody is your friend when it comes to trading. So one of the things about, just wait 1 second, sorry. Yeah. So there's statistics out there that 95% of day traders lose money. So in turbo trading, we want to be that 5% of the market that can hold on to the cash and make it. It's because it's a business for us. We're not gambling. We try to find patterns that work for us, because we know that only 7% at best of these patterns that will work. So, we need to let our profits run, cut our losses quickly, and we need to keep our emotions in check. It's an ice running through your veins, ice cold, emotional look on your face. We're not jumping up and down. We're not screaming. We have no emotion whatsoever when we trade. And we stick to our trading plan. Every time before we enter a trade, we make sure that we have a trading plan and that it's in place. And we have one friend, and that's the trend. Nobody else is our friend in the markets. So we accept the fact that only 70% of our patterns are going to work. And that's at best. And they're always changing. We always have to find new patterns that are working or adjust the patterns. For instance, lately, it's been buy the dip, sell the rip. Anytime a stock gets up into resistance area, the selling comes into it. People don't believe that this market's going to trade higher. They think that we're going to roll over and start trading much lower. And we see that in the IWM, which is the ETF for the Russell 2000, just a big consolidation pattern in here. And we see that in our technical indicators as well. Just no follow through with these stocks. So, we have to buy the dips, sell the rips. The breakouts aren't working. So we're always adjusting and we don't need to be attached to any one formula. We keep our emotions out of it and we just trade what the market gives us. And so here you go. While we're trading, we don't hope, we don't wish, we don't pray. None of those. As a matter of fact, these are all words that if anybody types them into our chat room, they just get deleted. We never hope for anything. We don't rely on luck. We have to make our own. We don't get FOMO, fear of missing out. One of the key killers for new traders. Chasing stocks. If you miss your entry, and you'll hear me say it all the time, I missed that entry. I missed it just by fractions of a second. But I'm not chasing. I don't chase it. I'll wait and see if it pulls back. If not, doesn't matter. There's going to be lots of trades. If you miss a trade, there's thousands of stocks every day that are trading. We always find the good ones. And if you miss this one, don't worry. There's going to be lots more behind it. So we don't chase stocks. We wait for the right buying opportunity, the right pullback, entry up, whatever the case may be. And if we miss a trade, we miss it. We look for others. The other thing we don't do is we don't ask others if they're in a trade. You just need to trade what your own pattern is, what you see. And one of the big things that newbies do is they ask others if this is a good level to buy or sell. You need to figure that out for yourself. You need to, watch and see what the big traders are doing, the professionals, where they're entering stocks. And if you don't have the conviction, if you have to ask whether it's a good level to buy or sell, then you don't have an understanding of the market or the chart pattern or the conviction to trade. You need to get over that. You need to be able to determine yourself whether it's a good buy or sell. And if it isn't, then get out of it. Or don't enter the trade. But if you have conviction and it goes against you, because 30% of the time it's going to, then you need to get out of the trade. Here's the other big one that the newbies quite often do, and those that don't have emotional detachment from the market. They ask if there's any hot stocks, or even worse, should we hold this overnight? Stick to your trade plan. There's always hot stocks everywhere. And in turbo trading, we call them when we see them. If we're not calling them, that means there's nothing's popping. There is no, you don't have to trade every instant of the day. You need to wait for the setups, wait for the good ones to come. And when they do, we act on them. This is important. If you're a new trader, you should have trading rules. And if you don't have any, we have lots on the Turbo Trading site, on the free stuff, TurboTrading.biz/free stuff. If you don't have your own trading rules, print these ones out, post them on your computer, on the wall by where you trade, on your screen, whatever the case may be. Read them every day, 10 times a day, 5 times a day, until they're ingrained in you. And make sure that you stick to your trading rules. Very important. If you let the emotions come into your trading, you're not going to stick to your trading rules, and you're going to lose money. Establish your price targets, establish your stop losses before you make a trade, so you know exactly what your trading plan is. Take the emotion out of the trade and stick to your plan. Stick to your trading plan. You can't emphasize that enough. We also want to understand what other traders are thinking. This is how we can get an edge. Once we understand our own emotions, we want to understand what everybody else is thinking. And so you can analyze and think like other traders, so you can be one step ahead of them. This is how you can help to develop your edge on a trade. We want to see the patterns that others see, but be ahead of them on their curve. So, and I've done videos on charting, charts and patterns and that kind of thing. I have a counterintuitive theory on patterns, and that is that I don't believe in them at all. It is hocus pocus. There's nothing by drawing lines on a chart that, or following the RSI or MACD or support resistance. They're all just a fantasy, really. But in saying that, and this is why it's counterintuitive, how can I say that? Because that's all we do here. Turbo Trading is technical analysis. The only reason patterns work is because that's what other people see. And because they have in the past worked they feel that in the future it's going to work. So if you're drawing lines on a chart or you're not seeing the same patterns as everybody else, your patterns are never going to work because nobody else sees that pattern. At key resistance levels or key support levels, why is it that? Or VWAP, which is a very popular one that I absolutely see very little use in, but a lot of people do. And why do they see it? Because that's what everybody else believes is going to be a pattern. So you want to make sure that you have patterns that everybody else is seeing, because if you're drawing lines on charts that nobody else is drawing, your patterns aren't going to work whatsoever. So, and patterns are the sum total of all the knowledge of all the traders or all the participants in that one stock at any one time. It's based on fundamental analysis, technical analysis, market conditions. All these things all go in to, at any second, there's a dot on the chart, and that's the sum total of all the knowledge, the buyers and the sellers, those that are bullish, those that are bearish, and it puts a point on the chart, and then that chart develops into a pattern. And it does include all the fundamental analysts, and it does include all the technical analysts. And so if you're drawing charts, if you're looking at a chart and seeing patterns that nobody else sees, then it's never going to work. You need to be able to see patterns that others see. And when you do, you need to be ahead of them on that chart pattern. Now that's different than buying. You don't want to buy in anticipation though, but you need, sometimes this is only going to give you a 30-second edge or, a minute edge for what others are seeing. But when it does, then you act on it and your trades will be successful. So in closing, it's acknowledge your emotions. All traders will experience at least one mind trap, but the very best traders learn to recognize, understand, and neutralize them. This process forms the foundation of any trader's training. Therefore, if you want to become a successful trader, you should first spend some time getting to know yourself and the particular mind traps you tend to fall into. A skillful trader tends to have a strong desire to master his or her emotions and prevent them from affecting his or her performance. So that wraps up the psychology of trading. Thank you very much for everybody participating with us. Thank you very much and have a great evening.
Don't forget to like and subscribe to our channel. A community of traders. Become a member at TurboTrading.biz. Reach new levels of trading proficiency. TurboTrading.biz.